We will continue our discussion on economy. We are in the module monetary policy in India, and in this session we will be talking about the types of monetary policies. Okay, and towards the end we will talk about quantitative easing and quantitative tapering, or tapering also we will discuss. So types of monetary policy, when we basically discuss about contractionary policy and expansionary policy. Okay, so I'll tell you what is contractionary policy and when it is done, and I'll tell you what is expansionary policy and when it is done. But before that, what are the monetary policy tools which is available with RBI? We have seen already there are quantitative measures and qualitative measures. So here we are going to talk predominantly about the quantitative measures. What are they? The quantitative measures are CRR, SLR, okay, and then we have discussed about bank rate. We have also discussed about the liquidity adjustment facility. In that we have discussed about repo and reverse repo. So repo and then reverse repo. So, and then we have also discussed about market stabilization scheme under quantitative measures. But here predominantly we are going to talk about these 5 tools which are available with RBI. So we'll see in different types of policies, like in contractionary policy how RBI is going to deal with these tools, and in expansionary policy how RBI is going to deal with these tools. Okay, now what is CRR? CRR is the percentage of NDTL, the money with the banks, which have to be kept in the form of cash with RBI at any point of time. So let's say 4% is the CRR, means out of the, let's say 100 rupees the total deposit. Out of the 100, you have to keep 4% in the form of cash with RBI. That is what CRR. At any point of time, you have to maintain this in the form of cash. What is SLR? SLR is that percentage of deposit which have to be kept with the bank itself in the form of mainly gold, okay, or cash, or the government securities. It can be any of this: gold, cash, or government securities. Cash, you won't get any return, so there is no point in keeping the cash idle. So what you prefer to do is either gold or government securities, and gold will give you maximum return, but gold is not calculated on the basis of market rate, rather a constant price, base price. So from gold also you won't get much return. So actually banks will maintain SLR in the form of government security. So let's say 18% is the SLR. Out of this 100 total with the banks have to keep 18% in the form of government securities or gold or cash, but they prefer 18% government security because you may get around 6 to 7% return from government securities. And if you have excess government securities, that is useful when it comes to repo. So we'll be discussing that. Okay, so that is what SLR. And I've discussed with you one question: which instrument of monetary policy forces banks to lend to government? That is SLR, because you have to compulsorily follow the mandatory requirement of SLR, and you have to compulsorily buy the government security. You have choices: gold or cash or government security, but gold and cash being, there is no point, there is no return, banks have to buy the government securities. So when you are buying government securities, means you are actually lending to the government. So which instrument of monetary policy force you to lend to government? That is SLR. Okay, then bank rate we have discussed. Under bank rate, banks can borrow from RBI, okay, by pledging what? By pledging first class securities. And I've told you examples: commercial paper, commercial bill, etc., that you can watch the videos and you will understand in detail. I'm not explaining too much here. So pledging first class securities you can borrow under the bank rate. What is repo? Under repo also you can borrow from Reserve Bank by pledging government securities. So what is the difference between these two, bank rate and repo? In bank rate you are pledging first class securities, that is the unsecured, the private entity securities. The repo, you are pledging the government securities, which is more secure. Government securities is more secure, so interest charged under repo is slightly less than the bank rate, because in bank rate there is a risk involved, so interest charged over there is slightly higher than the repo. So let's say 4.45 is the repo, plus let's say 0.25 basis point will be the bank rate, that is 4.7, like that. So slightly higher. The reason I told you, it is least secure compared to the government securities. Now technical definition of repo, I told you, RBI buy the government securities. RBI buy the government securities from the banks with an agreement to repurchase it at a predetermined date and rate. Okay, so at a particular date it has to be repurchased by giving back the money, and this rate is what you call as repo rate. This operation is what you call as repo operation. Okay, reverse repo, it is the opposite. RBI sell the government securities to bonds. That means selling means giving money to bonds, banks. Okay, and the rate at which this transaction has happened is what you call as reverse repo rate. So I hope this is clear. So don't tell that RBI borrows from bank. It is better to tell that RBI sells government securities, or banks keep money with RBI, and for that banks are paid certain interest. There is no point for borrowing from banks by RBI. There is no need to borrow from banks. Okay, RBI don't want to borrow from banks, so there is no logic in that. So I hope this is clear. Now let's move on to the monetary policies, types of monetary policies. I hope this is clear for all of you. Now monetary policies. See, if you have any doubt in any of the sessions, you can get in touch with me here. This is my Instagram ID. You can join the Telegram channel. You'll get all the economy videos that we have done so far. Okay. So let's go to types of monetary policy. First, we'll discuss about contractionary policy. Contractionary monetary policy. Contractionary monetary policy, or it is also known as dear money policy. Dear money policy. Dear money, that name itself will tell you. The both name itself will tell you what is the policy here, right? Contractionary, the contraction, and dear money is making much more dearer. How money will be much more dearer? Money supply have to reduce. So in contractionary monetary policy, RBI follow this policy, this approach, that money supply will be reduced. Now, why you need to reduce money supply? So when it will be done? Money supply is connected with inflation, right? So as we have already discussed before, Urjit Patel committee recommendations from 2014 onwards, inflation targeting or controlling inflation is the main priority of RBI. So when inflation is there, why inflation is there? Because demand is there. Why demand is there? Because purchasing power is there. Why purchasing power? Because more money supply. So how to control inflation? Reduce the demand. How to reduce the demand? Reduce the purchasing power. How to reduce the purchasing power? Reduce the money supply. So here contractionary monetary policies are followed to tackle inflation by reducing money supply. So any measures which are reducing money supply will come under here. Okay. So what are the measures? These are the monetary policy tools that is with RBI. So what can be done with CRR? CRR, let's say now it is 4%. That means you have to keep 4% with Reserve Bank, right? Now if you increase CRR, what will happen? When you increase CRR, you have to keep more money with the Reserve Bank, so your lending capacity will decrease. So when the lending capacity will decrease, means the credit creation capacity will decrease. Okay, the credit creators are the banks, so credit creation capacity will decrease. So money supply will decrease. Money supply decrease means purchasing power decrease. Automatically aggregate demand decrease and inflation will come down. So this is what going to happen when CRR increase. What will happen? The credit creation capacity, I'm just writing it like this, credit creation capacity obviously decrease. That lead to decrease in money supply. Money supply will reduce, okay, and that is result into less purchasing power, no money, no purchasing power. So demand, what will happen? Aggregate demand decrease. So as a result, inflation will reduce, and what will happen? Growth will come down, right? So growth will come down. So you are able to control inflation, but growth also will come down. Both cannot be achieved together. Okay, so if you try to control inflation, growth will come down. So this is actually a dilemma. This is what you call as a monetary policy dilemma. Okay, now to increase growth, if inflation is stable, what RBI can do? Do the reverse. Increase the cash reserve ratio. Instead of increasing, decrease it. Okay, so you need to keep less money with RBI, so you have more money to lend. So credit creation capacity will increase. So money supply will increase. Purchasing power will increase. Aggregate demand will increase. So growth will increase. When demand increase, growth increase, right? But what will happen with inflation? Inflation also will increase. I have already shown you with this diagram. So let's say here go for demand curve, aggregate demand. Here we will go for supply curve. Okay, so this is the national income on the x-axis, and on the y-axis we go for the price levels, average prices. So price level. So if this is the equilibrium position, now let's take the case where money supply is increased, so demand increased, so the demand curve shift rightward. So you can see here new equilibrium is this, right? So you see price increased, that is what you call as inflation. This is what you call as inflation. But you can see here national income also increased, so growth increased. So both will happen together. Now one more problem comes here when money supply increases. Okay, that problem is also connected with this monetary policy dilemma. Now it is a trilemma. What will happen? When you pump money to stimulate growth, money supply will increase. When money supply increase, the demand for dollar will also increase, right? Now, let's say the system that we are following is the floating system. So here, the quantity of dollar demanded and supplied. So here, price of dollar in terms of rupee. So let's say this is a demand for dollar, and this is a supply for dollar. So this is the current position. Now when money supply is more, what will happen? Demand for dollar will be more. So what will happen? The price of dollar in terms of rupee, let's suppose this is 60, this becomes 70. Price of dollar actually increased. This is what you call as depreciation. So one more effect that I can see here, when money supply increase, depreciation of rupee. So if you try to stimulate growth, what will happen? Your growth will increase, but inflation will be there, rupee will depreciate. I hope this is connected. This is a trilemma now. So if you promote growth, inflation will come, and rupee depreciation will also be there because money supply is there. So I hope this is clear. Now everything else is connected with this only. If you understood this example, now everything is going to be very simple and easy. So this is a trilemma. Now see, what about CRR? We are talking about contractionary policy. That means reduce money supply. So CRR, increase, money supply can be reduced. Similarly, SLR, what do you need to do with SLR? SLR also you increase. So you have to keep more money. So what will happen? Same thing will happen. Credit creation capacity will decrease. Money supply will decrease. Aggregate demand will decrease. Inflation will decrease. But growth will be affected. Exactly the same with bank rate also. Because bank rate is that rate at which banks can borrow. Now banks, if it is increasing, what will happen? Banks won't borrow much. So if banks won't borrow much means banks don't have much money to lend. So that result into decrease in credit creation capacity, decrease in money supply, decrease in demand, decrease in growth as well as inflation. Okay, same is the case with repo. Repo also, when you increase, banks won't borrow from RBI. Okay, and then that result into decrease in money supply. When you increase reverse repo, so repo, what you need to do? Repo increase, so money supply will decrease. Now reverse repo means if you increase, now you are getting banks. If you keep more money with RBI, banks get more interest, so they prefer to keep it with RBI, which is more safer. So more money will be kept with RBI if you are giving more reverse repo, right? So more money will be kept with RBI means money supply will decrease. So all monetary policy tools has to be what RBI have to do with all the policies? Increase all. CRR increase, SLR increase, bank rate increase, repo increase, reverse repo increase, all parts of contractionary monetary policy. Okay, so let me write down that definition. It seeks to reduce money supply in economy, decrease money supply in economy. That is the first objective. Now second, it is done to control inflation. So it is done to control inflation and also to check depreciation of rupee. Why rupee depreciating? I have told you money supply increasing. So reduce money supply, you can check depreciation of rupee. So all these are connected. So control inflation and also to check rupee depreciation. Okay. So what are the policy tools? CRR, SLR, bank rate, repo rate, cash reserve ratio, all have to be increased. Market stabilization scheme, you will buy back the bonds. What will happen when you buy back the bonds? Or you sell the bonds, right? Here you sell the bonds, you suck out the money. So that is open market operation you can do. Now what about expansionary monetary policy? Exactly the opposite. If the inflation is stable, you need to promote growth, right? So in case of expansionary monetary policy, your objective is to increase money supply. So in case of contractionary monetary policy, I have told you it is a dear money policy. This is cheap money policy. Now money is cheap. Now how will you understand this cheap and dear? It is a cost of money. What is the cost of money? It is the interest. So in case of contractionary, higher is the interest, dear money. Here lesser is the interest. Money is cheap. Okay, so I hope you understood. So inflation is stable. Now you can go for stimulation of growth, right? So what can be done? Increase money supply. How can you increase money supply? Let's take this first instrument, then everything else is connected with that only. CRR. If you decrease, what will happen? You decrease CRR, you need to keep less money with RBI, so your lending capacity will increase, credit creation capacity will increase. That will result into increase in money supply, result into increasing demand, and result into growth. Okay, so CRR decrease means purchasing power, or rather money supply increase. So purchasing power increase, that lead to money supply or purchasing power increase, that lead to aggregate demand increase, that lead to inflation. But here what will happen? Here growth will be there. Okay, because money supply is there, but rupee will depreciate because more money, you have more demand for dollar, so rupee depreciate. So to check depreciation, what you need to do? Contractionary policy. Okay, to check growth, what you need to do? Expansionary policy. To check inflation, what you need to do? Contractionary policy. Okay, so I hope you understood the dilemma. Dilemma is between these two. Trilemma is between these three. So this is what I want to explain in different policies. So I hope this is clear. Exactly the same thing is what RBI will do with SLR. If you need to increase money supply, here expansionary policy objective is to increase money supply. This question was asked last year. Every year they used to ask question from this. Nothing to memorize, only logic and concepts. So what you need to do with SLR increase. So you have more money to lend. More money to lend means money supply will increase, purchasing power increase, demand increase. Bank rate will decrease. Bank rate decrease means cost of borrowing from RBI will become cheaper for the banks. That cost of borrowing from banks will become cheaper for the people. So people will borrow from banks borrow from RBI, more money supply lead to growth, but inflation. Repo, same thing. Cost of borrowing from Reserve Bank will be cheaper for banks. So cost of borrowings from the banks will be cheaper for the people. So money supply will increase. Okay. So repo increase means money supply increase. Repo decrease. Here we are talking about decrease, right? Repo decrease means money supply increase because cost of borrowing is less. Repo increase means money supply decrease because cost of borrowing is more. Okay, so reverse repo decrease means what? Now reverse repo is less. Reverse repo is the interest that banks get from RBI. So it is less means banks won't keep it with RBI, or rather banks won't buy the securities from RBI. So more money with the bank, more credit creation capacity. So this lead to increase in money supply. So both less means money supply will increase. So there is nothing opposite, just the name is opposite, but the operation is same. Repo increase, reverse repo increase, both the same function. Repo decrease, reverse repo decrease, both the same function. So repo increase, money supply decrease. Reverse repo increase, money supply decrease. Same. Repo decrease, money supply increase. Reverse repo also decrease, money supply increase. So I hope this is clear. Now let's quickly discuss about this quantitative easing. These are done by developed countries like US, Japan, EU, etc. It is similar to open market operations done by RBI only. So under quantitative easing, what they'll do is they will buy the bonds. Buy the bonds means, what will happen when you buy the bonds, you'll pump money. So these money, excess money is there that will come to the developing countries, and that is useful. But the disadvantage I'll tell you now. So the idea is you will buy back the bonds. So it is done by the central bank of that country, the Federal Reserve in US. So why it is done? It is done basically to increase demand. So it is done to increase demand. Why increasing demand? Because increase in growth will be there. Now this won't be done by developing countries. Why? Developing countries already demand is there. Now if you do this, when you're pumping more money, what will happen? That lead to hyperinflation because more money supply. So it is typically done in case of developed countries, not in developing countries. So quantitative easing not in developing, it is in developed countries, US, okay, EU, Japan, etc. They do this. Similar to open market operation. I'll tell you what is it. It is an unconventional monetary policy measure. It is an unconventional monetary policy measure which seeks to stimulate economic growth or to counter recession by increasing aggregate demand in the economy. So it is basically to stimulate growth or to control recession by promoting demand. Okay. Now under this, what they will do, under QE, central bank purchases a predetermined value of bonds, from financial institutions for a predetermined time period. Okay, so predetermined time period. So when central bank buy bonds, what is actually happening? Buy bonds. So when you are buying bonds, what is the effect? Money supply will increase because you are paying for the bonds. Money supply will increase, so that will lead to increase in demand, so that will lead to growth. So this is what actually the objective. On the other hand, when you are buying bonds, one more impact, this can be asked in prelims, interest rate will decrease. Why interest rate will decrease? If you remember, I have told you what is the interest on bonds. Let's suppose this is a bond. Let's say face value, let's say $100 is written. Now this bonds are sold through auction. So different people like A, B, C, different financial institutions, they will go for auction, right? So 91, 92, 93, etc. different values will be there. So the banks, this Federal Reserve or in case of RBI will give it to this person who's quoting maximum amount, right? Because you are getting more money for the bond. The issuer is getting more money. What is the return for this person? Upon maturity, let's say 1 year, upon maturity, you will get 100. So you are paying 93, bought at a discounted rate, and you'll be getting 100. So this difference is the yield or the interest. So here 7 is the interest. Now, when you are buying back bonds, what will happen? Demand for bond will be high. When demand for bond will be high means this value, the price of bond will be high. When the price of bond will be high means this difference will be less. So that difference will be less means actually interest come down. Interest is coming down means investment will increase. So overall a positive market sentiment. A positive market sentiment. Now is it good for India? Okay, now we will see the impact on India. So, or the developing countries. What will happen when they get money under quantitative easing? They will pump this money into the developing countries where you get more return, more interest, right? So, what will happen? This lead to investment, right? There will be FDI. So, FDI will increase. The portfolio investment will increase. And, this lead to increase in Forex. So when Forex increase, now this is very important. When Forex increase, what is the advantage? Forex increase means it comes in the form of hard currency rather in dollar. So if you see here, this is a demand for dollar, and if this is a supply of dollar, okay, as we have discussed already, right now this is the price of dollar, let's say 60 in terms of rupee. Now when the quantitative easing happens, when more Forex comes, what will happen? Supply of dollar will increase, right? Supply of dollar increase means you need to shift the supply curve to right. So supply curve shift rightward. So you can see here 60 became like 50 or less than that. What does that mean? Rupee appreciate. Okay, so when Forex increasing, rupee appreciate. So quantitative easing, when it happens, rupee appreciate. But there is a problem. Now, this is not long term, right? This is a stimulus which is given for a short term. So anytime they can take this money back. So when the opposite happens there, that is a tapering, I'll be discussing that, this money will be taken back, right? So this is just a stimulus. So that is actually the problem. Short term, all these things are there. Investments will come, Forex will increase, rupee appreciate, overall positive market sentiment will be there. The Sensex will increase. Is there any impact on export? Yes, export will increase marginally, not very much like what you can see here, but investment, there is a direct connection, not related to export. If the question in your choices, if export increases an option, you have to pick it, because export increases marginally but investments increase drastically. Okay, so I hope you understood. And rupee appreciate if this is happening. Now the opposite is what? Tapering. So what is tapering of QE? It means, gradually reduce. So it is actually the gradual withdrawal of forex. So the reverse effect will come. So withdrawal of forex means flight of capital. All the money which came will go back. Now dollar is in demand, right? So what will happen? You can see here, there is a quantity and this is the price of dollar in terms of rupee. So if this is a situation like we have discussed, let's say 50 is the price of dollar or 60 is the price of dollar. Now when they take back the capital, what will happen? They demand dollar because they need to take dollar back, right? So demand for dollar increase. So this is the demand curve, and this is the supply curve, supply of dollar. So demand curve shift rightward, right? This shift you can see. So what will happen? The price of dollar will increase to 70. So the reverse effect will come when there is a tapering of QE. So that is the reason why we are not promoting this kind of things, because it is a stimulus. At any time it can be taken back. So during the incoming of forex, the rupee appreciate, the Sensex will increase. But when they take back, what will happen? Rupee depreciate and market will collapse. Okay. So it is very volatile. So I hope you understood what is tapering, what is quantitative easing, what are the expansionary policy, what are the contractionary policy. So if you go for a quick recap, expansionary monetary policy seeks to increase money supply, expand. Okay, there is a cheap money policy where the interest rates will be less. So what you need to do in case of CRR will be reduced, SLR will be reduced, bank rate will be reduced, repo will be less, and reverse repo will also be less. The reasons you understood, all these culminates into what? The credit creation capacity of the bank increase, that lead to increase in money supply, and that lead to increase in aggregate demand, and that lead to growth. So if you need to promote growth, what you need to do? Reduce all the rates. But what is the offshoot? Offshoot is the inflation. Okay, so inflation will be there. At the same time, what will happen when more money is there? Demand for dollar will increase. So rupee depreciates. So all these are actually happening together, right? So this is actually the monetary policy trilemma. These three. When I talk about dilemma, these two, growth and inflation. What is the main objective of RBI? To tackle inflation after the Urjit Patel committee. Now, what is the reverse contractionary policy? In case of contractionary policy, what you need to do with interest rates? CRR, you need to increase. SLR, you will increase. Bank rate, you will increase. Repo, you will increase. Reverse repo, you will increase. All the rates will increase. That means money become dearer. So dear money policy. Cost of money will be more. So what will happen? Credit creation capacity overall. All the impact of this credit creation capacity of banks will decrease. So that lead to decrease in money supply. So when money supply decrease, what will happen? Purchasing power will come down. So purchasing power will come down means aggregate demand will come down. Aggregate demand will come down means inflation come down because demand is not there. So it also affect the growth. Growth also comes down. Now what it leads to? Money supply is less means demand for dollar will come down. So appreciation of rupee. Okay, so this to appreciation of rupee, to check depreciation, this is what you need to do. To check inflation, this is what you need to do. But in case of growth, to check growth, this is what you need to do. So I hope this is clear for all of you. There is no need to have any doubt here. So I hope the monetary policies are clear. Any question, use your logic and then answer the questions. If you have any doubt, you're free to get in touch with me here. This is my Instagram ID. Join the Telegram channel. I've done hundreds of videos. You'll get all the videos. Okay. So see you guys. Thank you.